This is the biggest opportunity for all the old businesses, how they are exploiting the digital power in their own business, whether in distribution, whether it is in cost structure, whether it is in sales marketing, wherever digital success is there in harnessing the power of the business. The businesses which are already running, NBFCs, housing finance companies, banking has the biggest opportunity. New banks or a lot of even existing banks getting their digital strategy right is going to be extremely important in a competitive landscape. Chemicals is a much bigger opportunity in the sense that this manufacturing is a very thin opportunity, 3-4%, 5% EBITDA opportunity, and it can be a little volatile after some time. But chemicals and pharmaceuticals, particularly pharmaceuticals, I think pharmaceutical looks very interesting because we have a domestic base, I mean domestic demand base as well as export base of pharmaceuticals. That's a very interesting space, and India has a clear edge over there. And I spoke to a lot of people, and they are saying that they have done in 4 months more business than they have done in the last 1 year. So this digitization process, and they are saying that there is no alternative to India. So some of the, I mean, of course, the scale has advantage, but even the mid caps with the niches they have, I think they will do very well. I mean, I don't think, I think how well they have done in the last 5-6 years. I think next 5-6 years is going to be far more promising for them. It is to do with the life insurance, general insurance, asset management. So all these asset classes are going to become bigger, particularly insurance, life insurance, general insurance, both. They're in the very nature, they're very consolidated, very high entry barriers, and very longevity kind of franchise. They don't need capital in the sense that they are self-funded types. So there is no dilution of equity, and there is no net NPA kind of situation. So I think the valuation of these companies will be very different compared to a lenders.
See, you can say that the banks and financials are hit in a portfolio sense. Some parts are hit more, some are hit less. But you look at the airlines, you look at multiplex, or you look at some other sectors which are directly 100% hit, or even hotel, which we own otherwise. But these stocks are down less than the financials are down. So I find that completely ridiculous in some sense. So we will remain in that financials to a serious extent, and we have added a little bit. And on the negative side, our biggest bet would be auto sector, where if you let me give you a thought experiment. So let's say that every month some 100,000 units are sold, and for 4 or 5 months the market is closed or whatever, and therefore nobody has turned up to buy. These guys who thought about buying car in Jan and Feb, and they thought they'll buy it in March and April, haven't turned up. Because if for 5 months these guys had a 500,000 to buy, and they have not even turned up to the extent of 15% or 20%, because today it's not 100 units in the 6th month, and there was supposed to be new 100,000 people coming into the market to buy this month. How does it, I mean, it just looks wild to even think that, is it pent up demand or not? It is clear that there is no demand. We have two kinds of stocks in our portfolio. One which we call high confidence in reasonable return. That is stocks that are not supposed to go up 40-50% in a good year, or and then fall 30% in a bad year, but stocks which you feel will do reasonably well in a good market and will not embarrass you and blow you out of the water in a bad market. So in that, the number one stock, which also happens to be number one stock in the portfolio, is HDFC Bank and some other private sector banks. Actually, most negative on the consumer. One is because the consumer sector stocks were always very expensive, and they were more of a hiding place for the last many years in some sense, because it's not that they were growing massively. How to reconcile what is happening in the economy with the market? We finally agree with this new letter of how to define the economy different from V and U and L, that this is a K-type economy, where one line is going up, which is related to some sectors, and one line is in decline, and these things will increase over time, because whatever was the underlying trend before COVID, in many cases these trends have been accentuated, and therefore the disparity might become even more.
In the month of November in 2019, I made a presentation at a conference in Mumbai. And the presentation was that guys, and I'm talking to hundreds of Indian investors in the audience, and I said that, guys, you have been lied to. You have been misled by all your investment advisors, wealth manager, and mutual fund managers who have told you that India is the only game in town, India story, etc., etc. Long after that story has been overtaken by several other stories globally. And I put up the chart on the screen, which said that for 10 years, over the last 10 years, you made virtually zero returns in dollar terms by investing only in India. Nobody had ever told Indian investors that how badly off you are in a global context, right? It's like Kuenka-Medak syndrome, that we were never told that the world is a far bigger place. We have emerging market bonds. We have US investment grade bonds, because those have been very strong performers in the rebound. So again, it's not just equities where you need to look. Even debt, if bought wisely, can give you solid returns. And then, of course, we have around 10-15% in commodities, because we saw the dollar weakness starting in the month of May. And in fact, I've gone publicly that, we bought oil in the month of April in the mid-teens, and now it is 42. We have gold, and we bought silver also, 3-4 months back, which has been an absolute, rocket. Because the trade was moving away from the Nasdaq, which was moving away from the FANG, we could start to notice that, there are other markets which start to look good when the dollar weakens. So we broadened our allocations to all these markets. When you are diversified, you won't get wiped out, you won't get cleaned out, because something will save you. US Treasury saved us then, right? So, and we are thankful for that. So right now the pie is pretty well diversified, but it is not that it is diversification for the sake of diversification. We are in the best markets, best stocks, best sectors, and the best asset classes that we need to be at the present moment.